Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We have a lot to cover, as always. We're back with another Pimp My Portfolio. Adam Dawes is joining us in the studio. We're talking about what makes a company great, and we're going to talk specifically about some really high quality Australian companies. But first of all, we're going to start with the news, but not news that's moving markets, but rather news that I've updated my portfolio.
Well, I mean, that might move markets, so you never know. But yes, you've been shifting things around.
Yes.
We've been talking about our portfolios a lot of late.
Yep.
Both revealed our portfolios at on different episodes. If you haven't listened to those, make sure you go back and listen, because I think what you've done here has been come off the back of going through both of our portfolios. And
it was a valuable exercise to share what's in our portfolios, and I think, we want to be really transparent here, and obviously every time we talk about our portfolios, we need to be clear that this is what makes sense for us and our personal financial circumstances, and what we're doing isn't what you should necessarily be doing. It's not a personal advice or an offer to buy or sell anything. It's just us being really public and transparent about how we're investing. And so I've made some changes to my portfolio, and so I wanted to share them, I guess.
Nice. Well, let's get stuck into it. What have you done?
So I think the impetus for this change was my core portfolio is with Superhero, and they recently changed their brokerage to, it was free to buy ETFs, and they recently changed it to $2, but they grandfathered it in.
Yeah.
So I was riding that free brokerage for as long as possible. I didn't want to change anything to enjoy the free brokerage, but a couple of the unit prices of my ETFs went over the amount I was dollar cost averaging in them, so it was no longer working, so I had to change it. So I've taken this as the opportunity to change it. And I actually looked at changing brokers as well. I did the comparison with Betashares Direct, and I'll talk about why I stuck with Superhero in a second. But just to put the answer at the top, what I've done, I've recently updated my core portfolio, and it is now down to 4 ETFs. IOZ for the ASX 200, IVV for the S&P 500, VEQ, which covers Europe and the UK, and then VAE, which is Asia x Japan.
Yep.
So those 4 ETFs are now my core portfolio. The changes there, I consolidated. I had a mainland Europe ETF and a UK ETF, and I just consolidated them into VEQ. And that was, I actually just didn't realize it existed, and then it was in your portfolio. And so it just made more sense. So that is.
And when you say you consolidated, did you actually sell anything, or you're just starting putting money into this from scratch?
No, so I've actually sold the
UK?
The other ones, the UK and the old Europe one, and it's just because the capital gains on them weren't huge. So I figured it was best to just do it now, rather than let them keep growing. Yeah. Just because, purely based on the unit price and how much I wanted to invest, I've swapped VAS, the Vanguard Australian 300, for IOZ.
Okay.
And so that's just purely because you can't do fractional ETFs in Australia. And so that just made sense because of the amount I wanted to dollar cost average.
Because VAS is now just over 100 and IOZ is about $30.
Yeah, correct. Yeah. So that's my new core portfolio. Every fortnight investing.
Just on that, sorry, just to go a bit deeper, why not change the frequency of investing? So you still so you're just investing more at once.
I could, not invest fortnightly, but invest monthly.
Yeah.
I could do that. Personal preference. I just like the routine that I'm in of getting paid on a Monday, transferring it to my brokerage automatically on a Tuesday, and then buying on a Wednesday.
Just doing it all
automatically
in the same
in the
same
pay
thing.
cycle,
Yeah.
knowing that every pay is contributing to it.
Yeah.
And I know that I could still do the automatic transfer to my brokerage and then sit on it and then do it every month or do it every 2 months or whatever. I know that I could do that, but
Just personal preference.
just personal preference.
Fair.
Yeah.
Nice. So a couple of changes there. Talk us through the Betashares bit though.
Yeah. So as part of this, it was Betashares Direct is obviously getting a lot of buzz at the moment, and it's a platform for people who are unfamiliar where you can invest in any ASX listed ETF. I was looking at the auto invest option because that's what I want to do. I just want it all to be my core portfolio to be automatic. I want to be able to invest equal amounts in these 4 ETFs every pay, set and forget. That's my dream. So Betashares Direct doesn't have auto invest for non-Betashares ETFs.
Yes.
You need to use their custom portfolio feature. And with custom portfolio, you can make a custom portfolio of up to 10 ETFs from any provider in Australia. So
Sorry. To have auto invest, you need to create a custom portfolio.
No. So you can do auto invest for Betashares
Just
ETFs.
okay, gotcha.
So that's one feature that they have.
Gotcha.
But then if you want to do like automated investing into non-Betashares ETFs,
Yeah.
you need to go down this custom portfolio.
Yes. Yeah.
So for the custom portfolio, for portfolios over 10K, it's a 0.25% management fee on top of the ETF fees. And so right now, for the size of my portfolio, the Betashares custom portfolio fee and the superhero brokerage fee over the year would be similar.
Okay.
But the superhero brokerage fee won't scale as my portfolio grows because it's just based on the transaction. Whereas the Betashares 0.25% will scale as my core portfolio grows.
Technically there will come a point where it turns to a fee for superhero, but it's ages away.
No, it won't, because I'm still going to be investing the same amount.
Oh, I see what you're saying. Per investment. Yeah.
Maybe if I sold the whole portfolio.
Yes, yeah.
But yeah, like in that, over time, I'll be better off sticking with the $2 brokerage than I would be with the 0.25%
That's interesting.
fee. So just for that reason, there's no bad choices there, but for that reason, I've stuck with superhero.
So that's the fee essentially. You're paying that to get automated investing into non-beta shares. That's what they're paying for.
I could have done just auto invest into Betashares ETFs. That's obviously what Betashares are trying to push people into.
Yeah.
But I like the ETF choices that I've got.
Yeah. I feel like being led by that product feature is not the way to choose your ETFs.
Yeah. Exactly.
I think the way you've chosen them is the right way forward. Nice. Well, there's plenty of buzz around the Betashares Direct, so it's important to actually have a look under the hood at all those finer details.
Yeah. But it's a good platform. Like, don't get me wrong. Like, I think if you're using them, you'd be perfectly happy.
Yeah. Well, I also know a lot of the community use Betashares ETFs, but I do anyway. For a couple of mine. So.
But yeah, the 0.25%, it's
makes a
like
difference.
if you're automated investing into like a VAS or an IVV, where like the management fee is less than 0.1, you don't want to put 0.25% on.
No. Yeah. Sorry, and so there's no brokerage as well for the Betashares. That's
correct.
So it's all wound up in the management fee. Yeah. Nice. Well, some pretty good moves there.
Yeah. Well, hopefully that's it, and that's just ticks away
until IOZ goes over 100, and then.
Yeah. Well.
Which could be. Well,
it'll be a while.
It'll have to,
Yeah. Hopefully I've got a pay rise by then.
So this segment is called What Makes It Great. We've done it a couple of times over the past few months, and it's one that we really enjoy because it's where we pick apart businesses, in industries, and really look at one key characteristic that drives it, that makes it stand out, that makes it successful, so that we can learn about that characteristic and apply it to companies that we're looking at ourselves.
Yeah. Now, if we take a step back and think about investing in individual stocks, first principles, like what are we trying to do as long-term investors picking individual stocks? I think there's really 4 key things that you want to look for.
Yeah.
You want to find a company that's solving a customer's want or need.
Mm-hmm.
You want that company to have a strong moat or a sustainable competitive advantage that gives it pricing power.
Yeah.
The third thing is you want the company to be able to take those profits from the pricing power that it has and reinvest them at a high rate of return. And then finally, you want to be able to buy that company at a reasonable price.
Yeah.
I think if you can tick those 4 boxes, you're doing pretty well. And today in this segment, we wanted to drill down on that point number 3, the ability to take those profits and reinvest them at a high rate of return. Because we often find like really high quality companies that are making a lot of money, that have really strong moats, but struggle to have that reinvestment runway. Classic example are our former employers, Woolworths and Coles. They tick that first box. They solve a customer's want or need.
Yeah.
They have incredible moats. Like they have, like pricing power. They have like the best locations. Like they have so many. Yeah, they have so many advantages. And often they can be bought at a reasonable price. Like often their shares trade at reasonable valuations. But where they struggle is that ability to take profits and reinvest them. And it's not just these like big giants. Like a lot of like the really high quality businesses in Australia that we often speak about, these growth companies, they eventually get to the point where it becomes harder to find where that next leg of growth comes from. Classic example, REA Group, realestate.com.au, has been one of the best growth stories in Australia over the past, 20 years. But like at some point, Australia becomes pretty saturated, and then they have to make that leap overseas.
Dangerous.
Yeah, and they've done it reasonably well. Like they've pushed into Asia a little bit. They've pushed into America a little bit.
UK.
They tried to buy Rightmove in the UK, but like that's a big jump. That's,
It's a whole nother venture.
Yeah. And like we can go through a bunch of companies. Like WiseTech is another one where, like they've been an incredible growth story, but they've got 4 of the world's top 5 freight forwarders are already customers. Half of the world's top 25 are already customers. And so like there is growth there, obviously. And, now they're trying to launch adjacent products.
That's where they go.
Yeah, they've got CargoWise. They've launched ComplianceWise, container transport optimization. So they're trying to like cross-sell into other products. But it's just like this is something that can be hard to find.
Yeah. However, that's not the segment. The segment is to talk about companies where we have, or talk about a company that does have this.
Well, yeah, this is what sparked this thought.
Yes. Yeah. And last week, Netwealth released a business update, and they've been sort of front of mind for us of late. We've spoken a lot, not so much on the show, but in the office about the platforms and how incredible some of these disruptors are doing. Hub24, Premium, and Netwealth. It was a pretty impressive business update.
Yeah. Well, to be honest, it was pretty impressive. It was actually more impressive for Hub than Netwealth. But so these are essentially, think of them as brokers, online brokers for advised clients.
That's exactly what I say to my wife Harriet when I'm trying to explain what they are. They're brokers for advisors. We don't get them.
They've got heaps more functionality. You can buy off-market stuff, but at its core, it's a platform where you put money on and you buy and sell things.
Yes.
But we just look at these platforms and we think about the reinvestment runway they have ahead of them, and it is just it's pretty amazing. So the first way that these platforms have like a big reinvestment runway is that they're disrupting incumbent businesses. From Netwealth's recent update, Netwealth has about 8% of market share. Hub24 has about 7% of market share. But in this same update, they showed that over the past 12 months, net inflows, so Hub24 about 13 billion, Netwealth about 10 billion flowing onto the platform. You compare that to the big incumbents. So Insignia is the biggest player. They have about 20% market share. Net, they had a 4 billion in outflows. And then the second biggest player is CBA and Colonial. they had about 11 billion leave the platform.
Huge.
So it's like there's this disruption that's happening and that they're riding this wave. But then the second, I guess, like tailwind that they're riding is just superannuation. It's just, so the Australian platform industry has 1.1 trillion in funds under administration, and that has grown at an annual rate of 8.2% over the past 10 years. And a lot of that is just compulsory super.
Yeah. I mean, we just need to get into the super game.
Yeah. Well, it's just like
eToro buying spaceship. Like once you have that, like same with Raise. Like once you have that product, then you just get people locked in.
Yeah.
Oh my goodness!
It's
like the fund flow that you could rely on.
It's crazy.
It's crazy.
Which is crazy when you think how Spaceship fumbled that opportunity.
I know. They had it right there in front of them.
They were early that year.
Anyway.
So look, this isn't new news for people. Hub24 trades at about 110 price to earnings.
Crazy.
Netwealth trades at about 80 price to earnings. So, you know, if we go back to those 4 factors that make a good investment, the fourth one is you can buy it at a reasonable valuation. Probably not there at the moment, but it's just like, this is a clear example of like, this is like a generational reinvestment runway.
Not there at the moment, but also arguably what you generally see when you do have this changing of the guard, incumbents, high growth against slow growth. Like you think about some of the big tech companies as they were coming through, they were trading on ridiculous PEs for ages.
Yeah, I know what you're saying, but I feel like that argument was probably best made 10 years ago for some of these platforms.
You wouldn't be buying either based on PE?
I don't own either.
That wasn't the question.
Yeah. Well, yeah. Based on valuation. It's like a lot has to continue to go right for a long time for them to grow into those valuations.
True. Yeah. Hard to see. Yeah. I mean, if this fund flow continues though, like, game on.
It's just also quite competitive, and we would need to do some due diligence with advisors, I think, in terms of you know, it's not like Colonial and Macquarie and BT are going to take all this lying down. Like
no way.
Investing in their platforms.
Absolutely.
And
there's still a lot of ground to make up.
Yeah, AMP is still kicking around, although they lost
surprisingly
net almost 7 billion in outflows over the past 12 months. Which is crazy when you think like, so looking at these numbers, Colonial had about 11 billion in outflows. They have about 13% market share. So they're also riding this superannuation tailwind, and yet they still had 11 billion in outflows.
Nuts.
Net of this tailwind. Yeah.
Anyway, that's what makes it great. No, I put them on the watch list. 2 companies that we certainly enjoy seeing the updates from every quarter, or because I think recently we compared some of their numbers to the big tech guys as well, and it's phenomenal.
We looked at Netwealth's gross margin.
Incredible businesses.
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. If you're new to the show, this is a segment where we bring in an expert to review a community member's portfolio. But Ren, before we get into it and welcome our guest and our community member, there's been a bit of groundswell, and we know how many community members are out there wanting their portfolios pimped but cannot make it onto the show.
Yes.
But good news, our expert Adam Dawes has come to the party.
Yeah, that's it. Now, we know that the cost of financial advice is prohibitively high for a lot of people. Average statement of advice runs, $5,000 or $6,000 these days. But luckily, Adam has told us about something that he does for his clients that makes this whole world a little bit more accessible and a little bit more affordable. If you want, a limited scope statement of advice and your portfolio pimped, a one-on-one review of your portfolio, Adam has that offer. And if you want to jump on that offer, it's it's a tenth of the cost of the statement of advice. Runs at about $750, and you can get in touch with Adam by going to equitymates.com/advice, and we'll put you in touch.
Love it. Well, we should welcome Adam to the studio. Adam, welcome.
Great to be here. Absolutely.
You ready for the influx of equity mates who are going to take you up on that?
I'm so ready to help the community out there. That's exactly what I need to do.
Nice.
Absolutely.
Love
Nice.
that,
So
love
if you
that.
want some professional advice on your portfolio, as Ren said, equitymates.com/advice.
We would encourage you to still submit your portfolio for Pimp My Portfolio, but if
Of
you
course.
don't want it revealed to the world, you can go direct to Adam.
That's it. Well, today we do have someone who has submitted, and Jenny, welcome to Equity Mates.
Hi guys, thanks for having me on today.
No, we are super excited for this. So, Ren, as always, take it away. What's in Jenny's portfolio?
Yeah, so Jenny's portfolio is anchored by a number of big ETF positions, and then she has some individual stocks, both Aussie stocks and one international. So to start with, I guess the core part of the portfolio, the ETFs, she's got Vanguard Australia, Vanguard All World ex-US, and iShares S&P 500, so that's the US. And then a Vanguard International Shares ETF. And then finally, Global X India Nifty 50. And that's about 3/4 of the portfolio. And then we've got 6 or 7 individual stocks. Some of the bigger names are BHP, Eli Lilly over in the US, CSL, Cochlear, Goodman Group, Mineral Resources, and Paladin Energy. So, Dawesy, we always like to start with a bit of a
Yes.
nickname.
Yes.
So have you got one for Jenny's portfolio?
Well, this is a nifty portfolio because there's the India Nifty 50, and I think that's a great one, Jenny, to start with. How did you get to this Nifty 50? And because there's not a lot of people that invest in India, so I wanted to know your sort of thoughts behind that.
Well, it may have been through listening to some of the Equity Mates podcasts, actually.
Great. Damn it. No, that's good.
and
That's good.
listening to some of the thoughts on India and seeing how that is growing and the rate of growth over there, and looking at the VEU holding that I had, it doesn't have a heap of exposure to India, and I wanted to have a heavier exposure to India.
Yeah.
Hence, sort of trying to get into that one.
It's done really well though, yeah, correct? You've
Yeah.
I don't know what price you bought it at, but look, certainly this is one that everybody should have a bit of a look at. India has surpassed GDP growth of China, and that was about a year and a half ago, 2 years ago now. And so they are still growing at an exponential rate, where China at the moment is trying to stimulate their economy to keep propping up that growth. So I think that Nifty 50 is a really good one for you in the portfolio.
So, Jenny, before Adam gets into a few other positions, perhaps can you explain how you got to this point in your portfolio? What's the strategy been? And where to from here?
I guess try to keep it as simple as possible. So dollar cost average, buy some shares every month. And I've tried to sort of set up with about an 80% core, 20% satellite. So the core, obviously, all the ETFs, and the satellites with the stocks. That's basically where it's come from.
Nice. Good strategy.
Yeah.
Can't complain with that.
Yeah.
So, Dawesy, maybe if you start with the portfolio structure, that core and satellite approach,
Yeah.
sort of 80-20 and dollar cost averaging, and you talk about that, and then maybe let's get into some positions that stand out to you.
Yeah, so I think absolutely that core versus satellite approach is great, and what you're doing is correct as far as the ETFs are concerned. Some of the individual stocks, the satellites, potentially on your risk profile, you could go a little bit more risky. But they're all good quality blue chips, and I always get in trouble for always recommending blue chips. But I think, this one you could diverse out a little bit, which would be really, really good to see. But look, the core of the portfolio is obviously the Aussie and then the international. What I'd like to see in far as that asset allocation that you've got there is potentially start to look, I don't know if you own property, or potentially there's some fixed income products that you could have a look at inside of the portfolio, as well as international, as well as domestic, just to lift that profile. Remember, when interest rates start to fall, you want to be in fixed income or bonds, because bonds will appreciate over that time as interest rates fall. So it's a really good time to potentially diversifying out a little bit further of the portfolio. I think your international weighting is probably a little high, as well as your Aussie weighting is a little high. Generally, is a portfolio construction, you would look for 30% of your portfolio in international, 30% of your portfolio in Australian, and then using sort of 10% for property, fixed income, and some cash that you've got there. So if you're adding more to it, I would then start to diversify out into more of that sort of fixed income, those kinds of things, which will just pad the portfolio out perfectly.
What are your thoughts on that, Jenny?
Yeah, it's interesting that you say that and that you talk about risk, because before I came on the segment, my husband and I were chatting about it, and I think we've got quite different risk profiles, and I'm sort of quite comfortable with where things are, but I realise that there's quite a lot of overlap with the ETF holdings and some of the blue chip individual stocks that I've got, and he sort of thinks that we should be more aggressive to try and get a better return.
Yeah, so being aggressive or getting a better return is a double-edged sword, right? Because when markets are going down, your portfolio will underperform and continue because of that speculative nature. If you hold blue chip stocks, BHP, Cochlear, CSL, Goodman Group, fantastic businesses, your portfolio will hold up as well. I think we're in a growth phase of the market for at least another 12 months or so, bull market. We've seen that over the last sort of 9 months. So I still feel as interest rates are coming down, you've got the ability to go a little bit more risky. That doesn't mean you need to go into the penny dreadfuls. You can certainly go into the mid-cap space, that sort of 200, ASX 100 to 200. And you can have a look at some of those ones. Now, I don't want you to go over risk and then, go, bloody hell, Adam, why'd you push me into this kind of thing? But I think if you looked at it and then sort of went in that top 100 to 200 space, there's some amazing companies in there that could give you that extra growth that you're looking in the portfolio.
Now, Jenny, before we talk about finding more growth too much, I think it is worth just saying, like, some of your stock picks have had incredible growth. Goodman Group up 70% in the last year. Eli Lilly up 65% in the last year. So I wouldn't be too hard on yourself. Like, you've done pretty well with some blue chip names, but like, the growth has certainly been there.
Yeah, awesome. That's great to hear.
Adam, one question on the weightings of things. You mentioned there, roughly 30% in Aussie. Jenny's currently sitting at about 40% just in the Vanguard Oz ETF. Yeah. Is the suggestion to then divert investments from now to other investments to bring up the weightings of others, or would you be trimming it?
It depends how much, Jenny, you put into the portfolio on a regular contribution strategy or dollar cost averaging. So my first thought would be to not add more to the VAS, which is the top ASX 300. So you are getting that extra diversification, but it's all mixed with everything else, so it's hard to quantify. I wouldn't buy any more of that, and I'd start to pad out the rest of the portfolio with some new ETFs or some new stocks that you can look at, which would then give you the ability then to sort of better shape the portfolio. It's in great shape at the moment. It just needs some tinkering around the edges to get it right.
Fantastic.
Nice. Now, one last question, Dawesy, just around the ETFs. Now, Jenny, I think you did mention overlap. So Jenny has Vanguard International Shares, which is a global ETF. But then also has All World ex-US and then a US ETF. So that international exposure is potentially doubled up, but is that a problem to you, or is that?
So the Vanguards are great. They're really cheap. So as far as an MER, they're really good. So they're fantastic. The VGS, I think, is the Growth International, Vanguard Growth International Shares. So there would be some overlap with the IVV, which is the iShares S&P 500. So there's obviously a lot of growth companies in the US, right? The All World one, ex-US, is perfect. That complements the IVV, and I usually put that into portfolios. We want the US, which is IVV, then you want IOO, which is the top 100 global companies, and then you use the VEU as the all-world ex-US. So you're getting the rest of that exposure as well. So I think you're right there. That Vanguard International share, potentially there's a little bit more overlap there, Jenny, on that one. So you can go onto the ETF providers and they'll give you all of the shares and their weightings and those kinds of things. There's lots of shares in there, but you would be able to see that there's some overlap there.
Yeah, I actually was listening to one of the Under the Hoods for the Get Started Investing podcast and realised that I actually had a huge amount of overlap there. So then I stopped buying the VGS and moved into IVV because there was so much overlap between the two.
And you can't go wrong with the IVV. Yeah? It's the S&P 500. Remember, returns over the last 6 months have been basically out of the top 10 stocks, right? So 50% of the performances have been out of the top 10 stocks. Now, what's happening is the broader base of the S&P 500 is now starting to lift up. So you're getting that actual lift up, just not from the top 10 or the Magnificent 7 or 10 or whatever it is. It's now coming from the base, and I think S&P 500 is the right place to be.
Well, Jenny, I think Adam started this segment by saying your portfolio is nifty, and I think I think there's a lot right with it. So well done. Hopefully, we've given you some things to think about and keep building. But I think you should leave this call confident that you're doing a lot right and you're on the right track. So well done, and thanks for braving the segment and sharing your portfolio today.
Fantastic. Thanks so much for having me. It's great advice, and I'll get looking into some of those other options.
Well, a reminder, if you would like to submit to Pimp My Portfolio just like Jenny has, you can head to equitymates.com/contact. Also, if you would like to speak to Adam and get a personalized statement of advice just for your portfolio, then you can head to equitymates.com/advice and we will connect you. But Ren, as always, that brings us to the end of the show. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.